Hey, this is Wayne Wagner from Vizionary Wealth Management. Yesterday I had a conversation with a client who is retired, and she was asking the question how much we should have in safe investments or bonds or conservative investments versus more risky assets like stocks, private equity, things like that. And she was looking at the portfolio and she said, it feels like maybe we're a little heavy in equities at this point relative to where maybe some of the popular ideas or rules of thumb go. So are you supposed to take 100, subtract your year, your age, and have that percentage in bonds or something like that? So there's all kinds of rules of thumb running around the industry of how much you should have in bonds and conservative investments. And I explain that two things. First of all, the last 30 to 40 years of bond performance is not going to equal the next 30 or 40 years of bond performance. Here's why. The reason bonds are not going to perform over the next 30 or 40 years as the conservative asset class that they have been up to this point is that for the last 40 years, since about 1980, interest rates have been coming down. When interest rates drop, bond values go up. Therefore, bond performance is above long-term averages as interest rates are going down. Interest rates have bottomed out. Given the dynamics of inflation, given the dynamics of the valuation of assets, interest rates over the next 10, 20, 30 years are going to go up from here, not down. Therefore, bonds are not going to be the safe harbor asset that they have been for our parents. The next generation is going to have a real problem owning bonds and thinking they're going to get that nice steady 4 to 6% per year rate of return. Statistically, it's not going to happen given where interest rates are. Now, that's free. That's the point of this conversation is, and this is what I explained to my client yesterday, is we use a formula not of what percentage of your assets should be in bond investments. We use a formula called A+B+5C. And we want A+B+5C to equal 5 years of your needed cash flow. And we want to be able to identify A+B+5C at the drop of a hat anytime during your years of financial independence. A is how much cash you have on hand. We generally want 6 to 12 months of your expenses in cash at any point in time during retirement or during your years of financial independence. B is your conservative investment. So this is going to include some bonds, but there's a lot of other lower risk, lower volatility assets that we can bring to bear that are not going to have that risk profile and interest rate sensitivity that bonds have as you move forward, as we move forward from here. So A plus B, cash plus conservative investments plus 5C. What is C? Well, C is the dividends and income, that repeatable, dependable cash flow from your existing portfolio. It's dividends from stocks, maybe blue chip stocks, maybe companies that have growing dividends over time. It's interest and income from other kinds of assets, maybe real estate, maybe different kinds of bond funds or things like that. But it's A+B+5C, and we want A+B+5C to always equal at least 5 years of your necessary cash flow. Why? Where do we come up with that? Well, if we look historically when the market goes into crisis, so we look 1999 and we get 2000 to 2002, 3 straight down years in the market. We get 2008 and we get a fall off a cliff. We get 2020, 40% drop in 6 weeks. So when the market goes into crisis, the average period of time, the average length of time for the market to get back to zero is about 28 months. So let's call it 2.5 years. So what we're doing is we're planning to never have to sell a risk asset for 5 years. So we want A+B+5C to equal 5 years of your cash flow, because we want at any point in time for us to say, hey, we're not selling a single share of a single stock for the next 5 years minimum. I don't care if you're 52 and financially independent, if you're 62 and retired, if you're 82, I want to be able to lay our hands on 5 years of your cash flow. Why? Because that evaporates the conversation of, well, as you get older, you should have more money in bonds, or you should have more money in fixed income or lower risk investments. No, actually, if you're 88 years old and you have that 5 years worth of cash flow, all the rest of your money can be in stocks. Because the question's not, what is the stock market going to do this week, this month, or this year? The Friends song, right? The question is the stock market going to be higher 5 years from now? Why? Because at any point in time, you can stop spending, stop selling stocks if they go into crisis, and just live off the income that you've protected between A+B+5C. And we can do that for twice as long as the average recovery rate is. So if it usually takes an average of 2.5 years for the market to recover, we're planning for 5 years, or 2 times that. That gives us kind of if we think about the bell-shaped curve, that covers about 98-99% of all possible outcomes for your cash flow. So regardless of what the market does today, this week, this month, this year, 5 years from now, the stock market statistically is going to be higher than it is today. Therefore, it makes sense for us to protect 5 years worth of income and then allow the rest of your portfolio to be more risk-based, because we're not planning on touching it for at least 5 years. Here at Visionary Wealth Management, that's the kind of strategy, that's the kind of thought process we bring to this. I know it's not common knowledge, I know it's not rules of thumb, but I think it allows people who have the higher net worths, which are typically our clients, people who are seeking financial independence, not necessarily just a comfortable retirement, to think differently about their capital and allow them to think more strategically about leaving your capital, leaving your wealth, your children, institutions, organizations that you feel deeply about, and allow you to dream in a way that perhaps you wouldn't otherwise feel comfortable dreaming. Here at Visionary Wealth Management, we're always here with perspective for the decisions ahead. If this has been helpful, please reach out. Let's have a conversation.